So maybe you're thinking about buying a house and the word taxes isn't necessarily front of mind. Trust me, I don't like thinking about it either. Thankfully, we have people like this who that's their entire job is to think about taxes all day, every day. This is Allen Stiegemeyer, owner of Luca Taxes and Bookkeeping. He's an enrolled agent, certified tax coach, and personally does my own taxes. So he's a very patient man. And he is here today to talk us through 3 things that are really important for you to know about taxes if you're thinking about buying a house. Allen, are you ready?
I'm ready.
You're ready. Okay, let's jump right in, guys. Let's talk about 3 things you need to know about taxes when buying a house in Kansas City. Let's go. Number 1 should be obvious. This should not be the headline of the video, but I have to say it because I have seen a lot of people not doing this. And number 1 is pay your taxes, guys. Pay your taxes. As an agent, I have seen this negatively impact both buyers and sellers. Allen, do you see that happen often in your work?
Hundreds of times over the course of the years. It happens more often than not that someone comes to us as a new client or maybe an existing client we haven't seen in a while, and they are like, I've got to buy this house, it's my dream home, and they need all the tax returns done. And at that point, if they owed taxes, well, we can get the returns done, but then you have this debt that's going to affect your debt to income ratio when you do buy a house, and you need to make a payment plan with the IRS. You need to make sure that you are filing your taxes. So even if you don't have the ability to pay the taxes, still file them, because the statute of limitations for the IRS to come and collect never starts if you don't file the tax return. So if you get anything, file it.
What is the statute of limitations? I didn't even know there was one.
So it's 10 years from the date of assessment of the tax is how long the IRS has to collect it. And if it goes beyond that 10 years, the debt is forgiven.
Do they ever forget?
They do.
Really?
So with the budget cuts over the years and the less audits, they're focusing on the higher earners or the businesses that are not following all the compliance things they need to do to stay in compliance with the IRS.
So if you file and you do all the right things, you actually file, you get on a payment plan because you can't afford to pay it right away, that can still impact you though, right? How does a payment plan impact your debt to income ratio?
Well, just like any other debt, it would be a monthly payment that you're doing to the IRS. They'll typically accept a payment plan automatically if the debt is under $10,000, including penalties and interest. By law, they have to accept those plans. And they'll spread those out over usually 5 years, sometimes up to 72 months, depending on the amount it is and how much you can afford. So they'll accept any amount monthly that's under the 5-year time frame to pay it back.
Makes sense. Okay, interesting. So buyers, pay your taxes. Let's talk about sellers. Sellers, also pay your taxes. How does this impact if someone goes to sell their house and then, oh no, there's unpaid taxes sitting out there?
Yeah, I mean, that's going to show up on a title search. If you owe over $10,000 and you're paying the IRS by check, or if you owe over $25,000 and you're paying them automatically out of your paycheck, then you're going to have a lien on all of your assets that the IRS files, and by law, it just takes effect as soon as the debt goes over that amount. It's going to be there. So they will require you to pay the debt in full with the proceeds if you are in that situation and there is a lien on your house.
And what that means in like layman's terms is if you sell your house for $200,000 and you owe $150,000 on your mortgage, you think you'd take home the $50,000. No, not if you owe taxes. They will take it out of it. So moral of the story, whether you're buying or selling, pay your taxes. In addition to the nuisance of paying your taxes, there's another important thing that you must know about taxes if you're thinking about buying a house. And that is keeping up with your paperwork. And this doesn't mean actually having a physical file cabinet full necessarily. It can be saved digitally. But Allen, what are the most important documents that you see people scrambling for last minute?
So it's not as big of a deal in the age we're in now, where the original purchase paperwork is available from the county website and you're able to kind of see what the purchase price was. But for houses that are before that time or are in a state where that information isn't public, a lot of times people have a hard time figuring out how much it would cost to buy the house originally. In that situation, we have to recreate that to be able to calculate what your capital gain would be. So that is one big reason to keep track of that original paperwork if you have it from the title company. Additionally, improvements to your property, these are going to be improvements over $2,500, so we're talking new kitchen, new countertops, additions of rooms, bathrooms, remodel, that kind of thing, exceeding $2,500 adds to what you originally paid for the house. So say you buy a house for $120,000 and it's kind of a fixer-upper, but you see that it's got good bones and you put another $130,000 into improving it to where it looks like a luxury house and you want to move in. Then those costs that you incurred to get the house live-in ready is added to the purchase price when we're calculating your capital gain when you sell it later. So keeping track of those improvements that you've done along the way is really important as well, because a lot of times people will say, I sold my house for, $1 million, but I bought it for $100,000 in 1974, but we added a pool, we added a guest house, we added all this stuff, and they don't have any idea what they paid for it. And in that case, it's kind of a little bit of a loss, or they have to find those records. So knowing that up front is really important because it makes it a lot less difficult later.
And if you were really wanting an adrenaline rush today, we have an entire video on capital gains. So go back and watch that one for a deep dive on capital gains. What about paperwork regarding your income and like filing your taxes year to year? Do you see a lot of people missing important things with that, or what do you see there?
Yeah, so don't ever assume that your tax preparer has kept all of your records on your behalf, because it is the responsibility of the taxpayer to keep those records and they're returned to you upon delivery of the tax return. Most tax companies, yes, will keep those records digitized and can provide you copies of your W-2s, but that's not always the case and is definitely not required that they do that. And so keeping those W-2s at least for the last 3 years, sometimes maybe 5, is going to be important if the mortgage company needs to show that you have this income that's reoccurring.
Well, Luca Taxes and Bookkeeping has a handy dandy little portal where you can just go in and grab your old stuff if you remember your password. Not that Allen's had to give me my password before.
It happens, but yeah, we do keep those records as a backup, just so that a lot of times people can lose information, especially in a move or multiple moves, and we can get that information to them that the mortgage company needs.
So far we have 2 things that you need to know about taxes if you're thinking about buying a house. Number 1 is pay your taxes. Number 2 is keep up with paperwork. And number 3 is tax benefits to homeownership. I think a lot of people think that these are greater than they are, that buying a house means you can write off your entire mortgage payment, or every improvement you do, you can just write off. What are common tax write-offs that you see people doing year over year that are homeowners?
So the biggest one is called SALT tax, for like an abbreviation. State and local income tax is what it stands for. So that falls under the category of itemized deductions. So everybody in the United States gets the standard deduction by default. If you have itemized deductions that exceed the standard, then you are able to take that benefit of added deductions from the itemization. Now, back in 2018, when the law was changed, they put a $10,000 cap on how much your SALT taxes can be on your return. And so even if your real estate taxes are $8,000 and your income taxes on your W-2 are $10,000, between both spouses or one party, it's still $10,000. And so that's inhibited a lot of people from getting a benefit on their taxes from buying a home, because that cap only gets you about a third of the way there to itemizing if you're married filing joint, and it would get you within $4,000 if you're filing single. So the next item is mortgage interest. Now, if you've bought a house since 2022, you're paying a higher mortgage interest rate more than likely than...
Sad violin for everyone that doesn't have a 2% mortgage interest rate.
So unfortunately that is the case, but we've got to stimulate the economy, and that is above my pay grade. So those interest rates that have increased do cause you to pay more interest monthly than you would be principal. Now, mortgage interest doesn't have a cap on the dollar amount of the interest that you can itemize, but there is a cap on the dollar amount of the house. So your house that you're purchasing has to be under $750,000 for you to be able to take advantage of the mortgage interest.
Interesting. Is there a difference between Kansas and Missouri on all this?
So yes, Kansas actually is one of the states that allows you to take an itemized deduction and still take the standard deduction at the federal level. So the standard deduction for states varies by state, but it's significantly lower than the federal standard deduction. And so normally in Missouri, the case being, if you file the federal return as a standard deduction filer, you're required to file the standard deduction with Missouri, and vice versa, itemize and itemize. But with Kansas, you can take the standard at federal and you can itemize on the Kansas and get that added benefit at the state level, and the threshold is much lower. I mean, for the most part, almost anyone who lives or works in Kansas can take advantage of this if they own a home.
Mm-hmm. Interesting. Okay, well, if you're like me and you're self-employed or a business owner of any sort, listen to all of this, but this is 6 times more complicated, maybe 16 times more complicated. Yeah. Because for me, I sell houses all over the KC Metro, Kansas, Missouri, KCMO, so there's different tax jurisdictions on every single house I sell. Right. Thank you so much for your patience on my taxes, but if you are a business owner and you're thinking about buying a house, think in advance. Even if you're 2 years out from buying a house, it's really important to get a good grasp on what your target income goals are to make sure your numbers are shaping up just right on paper as you stare down your home purchase.
Exactly. Yep. The budget's got to make sense for what you're wanting to do.
For sure. So the main 3 things you need to know about taxes if you're thinking about buying a house in Kansas City is, number 1, pay your taxes. None of us like to do it. It's not fun, but you have to. Number 2, keep up with your paperwork. Make sure you have a digital trail of all of your taxes and your income to keep things in shape when you go to buy. And then number 3, pay attention to the tax benefits of homeownership that maybe not as great as you hope, but they are still there. So take advantage of them. Alan, thank you for being here today. I appreciate you taking the time. Thank you for being the kind of human that enjoys taxes, which makes me question a lot of things about you, but we'll get into that another time.
Yeah, thanks for having me. Yes.
Guys, thanks for watching. We'll see you next time. Until then, I'll be here giving you the scoop on all things Kansas City on YouTube. Bye.